Investing looks simple from a distance. Buy good things. Wait. Become wealthy. Yet history shows a different picture. Intelligent people fail. Experienced people fail. Even professionals fail. The reason is rarely lack of information. It is usually behavior. Benjamin Graham wrote that the investor's chief problem, and even his worst enemy, is likely to be himself. This truth has repeated across generations. Markets test patience. They test discipline. They test emotional control. When prices rise, confidence expands. When prices fall, fear takes control. In both moments, human nature pushes investors toward costly decisions. Many losses that look complicated in public are simple in private. Someone chased speed. Someone followed the crowd. Someone ignored risk. Someone believed this time would be different. Small errors can grow into life-changing damage, not because people are foolish, but because they are human. Understanding mistakes is powerful. Avoiding them is even more powerful. This book is about the patterns that quietly destroy wealth. They appear again and again, in different countries, in different decades, to beginners and experts alike. If you can see these traps early, you can step aside. If you can step aside, time can become your partner. And that brings us to the first and most tempting danger: the belief that money should come easily. Let us begin. Chapter 1. The Illusion of Easy Money. The idea of easy money is powerful. It attracts beginners and experienced investors alike. It whispers that wealth can arrive faster than patience. It promises reward without long waiting. At first, the market may even agree. Prices rise. Profits appear. Confidence grows. The investor begins to believe skill has replaced luck. Caution starts to feel unnecessary. Risk feels smaller than it truly is. Warren Buffett once said that nothing sedates rationality like large doses of effortless money. When gains come quickly, thinking often slows down. Easy success can be more dangerous than early failure. Failure teaches respect. Fast profit often teaches boldness without understanding. Stories of sudden wealth are everywhere. A friend made a fortune in a short time. Someone bought at the perfect moment. Someone else discovered a hidden opportunity. These stories travel far. They grow with every retelling. What disappears is the risk that was present. What disappears is the role of chance. The listener hears only the victory, never the uncertainty. Soon a belief is formed. If others can do it, why not me? If it worked before, it should work again. The investor moves from curiosity to urgency, from urgency to action, from action to exposure. In this emotional state, careful study feels slow. Doubt feels like weakness. Waiting feels foolish. Speed becomes attractive. But markets have a rhythm that punishes impatience. They reward preparation. They reward endurance. They rarely reward excitement. The illusion of easy money convinces people that the future is clear. It makes risk appear friendly. It encourages larger decisions than wisdom would allow. At the peak of optimism, warnings sound boring. Conservative voices appear outdated. Experience is ignored in favor of enthusiasm. Yet the mathematics of loss never changes. A large fall demands an even larger recovery. Time is required. Energy is required. Confidence is shaken. Many investors discover too late that what looked simple was fragile. Charlie Munger liked to remind people that it is not supposed to be easy. Anyone who finds it easy is stupid. The statement sounds harsh, but inside it lives protection. If investing feels effortless, something important may be missing. Perhaps the danger is hidden. Perhaps the price already assumes perfection. Perhaps enthusiasm has replaced margin for error. Easy money thinking also changes behavior in subtle ways. People stop asking what could go wrong. They stop imagining alternative outcomes. They begin to concentrate instead of diversify. Why spread risk if success feels certain? This mindset slowly builds vulnerability. One surprise can damage years of progress, and surprises always exist. Markets are influenced by events nobody can predict. Economic change, political decisions, human emotion, global disruption. Confidence built on speed rarely survives shock. Another quiet danger appears. Gratitude disappears. Expectation replaces it. When investors expect quick rewards, normal returns begin to feel disappointing. Patience becomes harder each day. They search for something more exciting, something faster, something bigger. In that search, standards fall. Quality weakens. Speculation increases. What began as optimism slowly becomes greed. Greed rarely announces itself loudly. It often arrives dressed as opportunity. The investor believes he is moving forward. In reality, he may be moving toward exposure he does not fully understand. History shows that periods of easy gains are usually followed by painful lessons. Not because markets are cruel, but because humans forget risk when reward has been generous. The illusion is strongest just before reality returns. And when reality returns, it does not negotiate. Prices fall faster than they rose. Liquidity disappears. Confidence evaporates. Those who believed money was easy now face decisions under pressure. Sell and accept loss, or hold and hope. Neither option feels good. The emotional comfort that came with rising prices is gone. In its place stands uncertainty. Many investors promise themselves they will be more careful next time. They promise to study more, to respect risk, to slow down. But memory fades when markets recover. The cycle can begin again. Understanding the illusion of easy money is the beginning of maturity. It reminds us that wealth built slowly is usually stronger. It reminds us that survival matters more than excitement. Most important, it prepares the mind for independence. Because once someone recognizes that popular enthusiasm can be dangerous, a new challenge appears. If easy money is often an illusion, what happens when everyone around you still believes in it? What happens when friends, media, and experts move together in the same direction? Standing apart can feel uncomfortable. Disagreeing can feel risky. And that is where the next great mistake waits. Following the crowd. Chapter 2. Following the crowd. Human beings are social. We look to others for signals of safety. When many people move in one direction, it feels natural to follow. In daily life, this instinct can be helpful. In markets, it can be expensive. When prices are rising and everyone appears confident, agreement feels intelligent. Doubt feels unnecessary. Standing aside can even feel foolish. The investor begins to measure decisions by popularity rather than quality. If many people are buying, it must be right. If many people are selling, danger must be near. Comfort replaces thinking. Howard Marks has explained that to achieve superior results, you must think differently and better than the crowd. Different is uncomfortable, but comfort rarely produces exceptional outcomes. Crowds create powerful emotional pressure. They generate stories that support the trend. They repeat opinions until those opinions sound like facts. The more people agree, the harder it becomes to question. A strange transformation takes place. Risk begins to feel smaller because it is shared. Responsibility feels lighter because many others are involved. If everyone is wrong, the individual feels less alone. This thinking is dangerous. Markets do not reward consensus. They reflect it. By the time an idea becomes popular, prices have usually adjusted. The opportunity that once existed may have disappeared. Yet the investor sees only rising charts and confident voices. Momentum looks like proof. Benjamin Graham described the market as a voting machine in the short term. Popularity can dominate reality for long periods, but eventually fundamentals matter again. When they do, the crowd can change direction with stunning speed. The same people who felt brave while buying may suddenly feel terrified. Agreement turns into urgency. Urgency turns into panic. Because many investors enter together, many try to exit together. Prices fall. Liquidity shrinks. Regret spreads. The comfort of belonging disappears exactly when it is needed most. Why is resisting the crowd so difficult? Because independence carries emotional cost. When you disagree, you may look wrong for a long time. Others may appear smarter. They may celebrate while you wait. Patience during disagreement can feel lonely. But history shows that major bubbles were built on collective confidence. And major crashes often began when that confidence finally broke. The crowd is loud at the top and desperate at the bottom. Between those extremes, quiet discipline is hard to maintain. Media attention strengthens the pull. Experts appear with persuasive explanations. Predictions sound certain. If respected voices agree, resistance becomes even harder. Yet experts are human too. They feel the same emotions. They experience the same fear of missing out. Authority does not remove vulnerability. Following the crowd can also reduce curiosity. If everyone agrees, why investigate further? If everyone is optimistic, why prepare for trouble? Questions fade away. Without questions, risk grows unnoticed. Another problem appears. When investors act together, they often buy similar assets. Portfolios become crowded. Diversification weakens. A single negative surprise can hurt many people at once. The illusion of safety was created by numbers, not by strength. Independent thinking does not guarantee success, but blind agreement almost guarantees mediocrity. To step aside from the crowd requires courage. It requires accepting temporary discomfort. It requires trusting analysis more than applause. These qualities are rare during booms. They are praised only after busts. Most people recognize the danger in hindsight. During the moment, participation feels reasonable. The investor who wishes to avoid expensive mistakes must build habits before emotion rises. Rules about valuation. Rules about diversification. Rules about patience. These rules act like anchors when excitement tries to pull the mind away. Without them, social pressure can become overwhelming. Over time, many fortunes have been damaged not by ignorance, but by imitation. People simply did what others were doing. They assumed the group must know something. Often the group knew very little. Recognizing this truth can be unsettling. But it is also liberating. It means you are allowed to pause. You are allowed to question. You are allowed to walk away from popular enthusiasm. Because survival and long-term success depend more on discipline than belonging. And once an investor begins to separate from the crowd, a deeper awareness develops. If many people can be wrong together, then danger may hide even when confidence is high. That realization leads directly to the next mistake. Ignoring risk. Chapter 3. Ignoring risk. Risk is easy to forget during good times. When markets rise, mistakes hide behind success. Profits create comfort. Comfort reduces caution. The investor begins to focus on what can be gained. Thoughts of loss slowly fade away. This change feels natural. It even feels optimistic. But it opens the door to serious damage. Warren Buffett has said that risk comes from not knowing what you are doing. In rising markets, many people believe they know more than they actually do. They confuse outcome with skill. If money was made, the decision must have been correct. If others are succeeding, danger must be small. Yet risk is often highest when it feels lowest. Why? Because prices may already assume perfect conditions. Any disappointment can then produce sharp reactions. Investors who ignore risk tend to build fragile positions. They concentrate too much. They depend on continued optimism. They leave little room for surprise. For a while, nothing goes wrong. Confidence grows stronger. But markets are influenced by countless forces: economic shifts, competition, human behavior. events that cannot be predicted. Sooner or later, something unexpected appears. If preparation is weak, damage can be severe. Seth Klarman wrote that risk is not inherent in an investment, it is always relative to the price paid. Pay too much, and even a great company can become dangerous. Ignoring this relationship is common during enthusiastic periods. People become willing to accept smaller margins of safety. They justify higher prices with hopeful stories. Hope is comforting, but it is not protection. Another reason investors neglect risk is that caution rarely feels urgent. Preparing for trouble seems unnecessary when everything looks fine. Buying insurance on a sunny day feels strange. But storms do not wait for preparation. Wise investors understand that survival is the foundation of success. Without survival, compounding cannot continue. Large losses create heavy burdens. They require time to recover. They can damage confidence. They may force decisions at the worst possible moments. Avoiding these situations is more important than chasing extraordinary gains. Risk management may appear boring. It may limit excitement. It may even reduce short-term return. But it protects the future. Many famous financial disasters shared a similar pattern. Warning signs existed. Leverage increased vulnerability. Optimism delayed action. By the time reality became obvious, options were limited. Investors who respect risk try to imagine what could break their plans. They test assumptions. They prepare emotionally for volatility. Preparation does not remove uncertainty, but it reduces shock. It allows clearer thinking when pressure arrives. Ignoring risk also affects sleep. Deep inside, the mind recognizes exposure. Anxiety grows quietly. When markets finally turn, fear can become overwhelming. Decisions made in panic are rarely wise. The investor who had planned for difficulty can respond with patience. The one who never imagined loss may react with desperation. The difference between these reactions often shapes long-term results. Respecting risk encourages humility. It reminds us that the future cannot be controlled. It encourages diversification. It encourages careful pricing. Most of all, it encourages endurance. Because investing is not a single moment. It is a long journey filled with uncertainty. Those who survive many storms often win, even without spectacular brilliance. As awareness of risk deepens, another temptation becomes visible. If uncertainty is everywhere, perhaps constant action feels safer. Maybe moving quickly can prevent loss. Maybe trading more often creates control. This belief sounds reasonable. It feels energetic, but it carries its own danger. And that is where the next mistake begins. Trading too often. Chapter 4. Trading too often. Action feels powerful. Movement creates the impression of control. When uncertainty appears, doing something can feel better than waiting. In markets, this instinct can become expensive. Investors often believe that frequent decisions will protect them. If conditions change, they will react. If news appears, they will adjust. If prices move, they will respond. This constant readiness seems responsible. It feels professional. But activity is not the same as progress. Peter Lynch observed that far more money has been lost by investors preparing for corrections than in the corrections themselves. Fear of future problems can create present mistakes. Each trade carries cost. There are visible expenses. There are hidden ones. Taxes may rise. Spreads may widen. Opportunities may be missed while attention is elsewhere. Most damaging of all, emotional energy becomes exhausted. Frequent trading keeps the mind in a permanent state of alert. Small movements begin to feel important. Patience becomes harder to maintain. The investor starts reacting to noise rather than signal. Short-term fluctuations are normal. They are part of market life. But when every movement demands action, strategy disappears. Without strategy, decisions become scattered. Another problem develops quietly. The investor never allows ideas enough time to work. Many good investments require endurance. They grow slowly. they experience temporary setbacks. If positions are constantly changed, the power of compounding is interrupted. The portfolio becomes a series of short experiments instead of a long plan. Warren Buffett has joked that the stock market is designed to transfer money from the active to the patient. Patience is difficult when action is always available. Technology makes trading easier than ever. With a few decisions, positions can be opened or closed. Convenience can become temptation. Because something can be done, it feels like something should be done. Yet many of history's strongest results came from sitting still. Great businesses often reward those who hold through boredom, not those who jump from idea to idea. Trading too often can also create false confidence. If one quick decision works, the investor may feel skilled. If another fails, a new trade promises recovery. This cycle encourages even more activity. Losses demand repair. Repair demands speed. Soon the investor is busy all the time, but moving nowhere. Constant involvement reduces perspective. It becomes harder to step back and evaluate calmly. The mind focuses on recent outcomes. Long-term goals fade into the background. When this happens, investing slowly turns into speculation. The emotional swings become stronger. Excitement during gains, frustration during losses. Peace becomes rare. Many investors eventually realize they are tired, not only financially, mentally. They have spent enormous effort without proportional reward. At this moment, an important question appears. What if less action could lead to better results? The idea may feel uncomfortable. It can even feel lazy. But restraint often requires more discipline than activity. To wait while others move demands confidence in the plan. To hold while others panic demands courage. These qualities are built before market stress begins. Investors who trade less usually know why they own something. They understand its value. They accept that volatility will occur. Because they expect difficulty, they are not surprised by it. Frequent traders, in contrast, often depend on smooth progress. When interruption arrives, reaction replaces reflection. Another hidden danger of constant trading is distraction. Time spent chasing small advantages is time not spent improving knowledge. Energy that could build understanding is consumed by motion. The investor becomes busy, but not wiser. In the end, markets tend to reward clarity and endurance more than speed. This does not mean decisions should never change. New information matters. Mistakes must be corrected. But change should come from thoughtful evaluation, not restless emotion. When action becomes habit, it is easy to forget this difference. And from this restless environment, yet another mistake can grow. After spending so much time choosing a position, defending it, and living with it, attachment may begin to form. The investment starts to feel personal. Letting go becomes harder, which leads directly to the next danger. Falling in love with a stock. Chapter 5. Falling in love with a stock. Investing begins with analysis. Numbers are reviewed. Prospects are considered. Risks are measured. At the start, the relationship is rational. But time changes things. The investor reads more about the company, follows its progress, defends it in conversations. Gradually, distance disappears. What was once a position becomes a commitment. What was once an idea becomes part of identity. This transformation is subtle. It feels like confidence. It feels like knowledge. Yet it can become a trap. Philip Fisher encouraged investors to know their companies deeply. Understanding is valuable. But deep familiarity can sometimes create emotional attachment. When attachment forms, objectivity weakens. Positive news feels larger. Negative information feels temporary or unfair. The investor begins searching for evidence that confirms the original decision. Contradicting facts are explained away. A protective story is built around the investment. Soon, selling feels like betrayal. But the market does not reward loyalty. It responds to reality. Businesses change. Competition increases. Management makes mistakes. Industries evolve. No company is guaranteed permanent success. When investors fall in love, they may hold long after the reasons for owning have disappeared. Losses grow slowly at first. Hope remains strong. Perhaps the decline is temporary. Perhaps the market is wrong. Perhaps recovery is near. Sometimes this will be true. Often it will not. Benjamin Graham advised investors to approach stocks as businesses, not as emotions. A business decision should be based on value, not affection. Yet affection is powerful. The more time and energy invested, the harder it becomes to admit error. Selling can feel like confessing failure. So the investor waits. And waits. Meanwhile, capital remains trapped. New opportunities pass by. Attachment creates blindness to alternatives. Another danger appears when investors speak publicly about their holdings. They recommend them to friends. They defend them online. Pride becomes involved. Now changing opinion is even more difficult. Admitting doubt may feel embarrassing. To protect reputation, investors may protect the position instead. This decision can be very costly. Love also encourages concentration. If the company is wonderful, why own anything else? Diversification begins to look unnecessary. Exposure increases quietly. When trouble eventually comes, impact becomes severe. Even great businesses experience periods of disappointment. Unexpected events can challenge the strongest models. If attachment prevents clear judgment, reaction may come too late. Falling in love can also create unrealistic expectations. The investor begins to believe the company will always succeed. Growth will always continue. Management will always act wisely. Reality rarely behaves so perfectly. When expectations are too high, even good results can disappoint. Prices may fall not because the company failed, but because hope was excessive. The emotional investor struggles to accept this difference. He believes the market is unfair. He waits for recognition. Time passes. Opportunities elsewhere grow. But attachment keeps attention fixed. There is a quieter psychological force at work. Ownership can create a sense of control. By holding the shares, the investor feels connected to outcomes. Letting go removes that feeling, but true control in markets is limited. We can choose our behavior. We cannot command results. Understanding this requires humility. Wise investors try to create rules before emotion takes over. They define reasons to buy. They define reasons to sell. If conditions change, action follows. Rules act as protection against attachment. Without them, decisions depend on mood. And mood can be very persuasive. It whispers that patience is noble, that loyalty will be rewarded, that endurance proves strength. Sometimes patience is correct. Sometimes it is denial. The difference is difficult to see when love is involved. Markets have humbled many talented people in this way. Intelligence did not fail them. Emotion did. To remain objective requires constant effort. It requires willingness to revisit assumptions. It requires openness to unpleasant information. Most of all, it requires remembering that capital is limited. Every moment spent in a weak position is a moment not spent in a stronger one. Opportunity cost is invisible, but powerful. Investors who master detachment are not cold. They are practical. They appreciate good businesses. They celebrate success. But they are ready to change when evidence changes. They understand that love is wonderful in life. In investing, it can be dangerous. And yet, even those who avoid attachment can fall into another trap. After seeing potential, after building conviction, they may want to increase results faster. They may seek to amplify returns. One common method promises exactly that: borrowing to invest. It appears logical, it appears efficient, but it carries risks that can erase years of progress. That is where we go next. Chapter 6. Borrowing to invest. Borrowing money can make success appear larger. If an investment rises, gains increase. Results look impressive. Confidence expands quickly. This promise is attractive. Why grow slowly? The investor wonders if growth can be accelerated. Why wait patiently if money can work harder right now? Leverage offers speed. But speed changes the nature of risk. When borrowed funds are involved, time becomes sensitive. Volatility becomes threatening. Small declines can create big consequences. What once was a temporary fall can become permanent damage. Charlie Munger often warned that there are only a few ways a smart person can go broke, and leverage is one of the most reliable. Debt removes flexibility. Without borrowing, an investor can wait. With borrowing, waiting may not be possible. Lenders demand payment. Markets do not promise recovery on schedule. This mismatch creates pressure. Pressure influences behavior. Decisions made under calm conditions may change completely when survival feels uncertain. Fear becomes intense. Clarity disappears. Assets may be sold at the worst possible time simply to satisfy obligations. The tragedy is not only financial, it is emotional. Investors who believed they were acting intelligently suddenly face loss of control. Borrowing can also magnify mistakes in judgment. If analysis was too optimistic, consequences grow faster. Even small errors become heavy burdens. Leverage assumes the future will cooperate. It assumes that volatility will remain manageable. It assumes that unexpected events will be limited. History rarely supports such confidence. Markets surprise participants again and again. Shocks arrive from directions nobody predicted. When they come, borrowed money turns inconvenience into crisis. Warren Buffett has said, "You never know who is swimming naked until the tide goes out." Leverage removes the margin for embarrassment. Weakness becomes visible quickly. During rising markets, borrowing feels safe. Asset values increase. Collateral looks strong. Lenders are comfortable. Investors are optimistic. Because nothing seems wrong, caution fades. But safety created by good times can be temporary. If prices decline sharply, the same structure that felt powerful becomes fragile. Margin calls may appear. Additional funds may be required. If they cannot be provided, positions may be forced to close. Often this happens near market bottoms. Recovery, which might have occurred with patience, becomes impossible. The investor is removed from the game. Many great financial failures followed this pattern. Ambition grew. Borrowing increased. Then conditions changed. What looked manageable became overwhelming. Another hidden danger is psychological. Leverage can encourage investors to take risks they would normally avoid. Because borrowed money amplifies reward, temptation increases. Prudence weakens. Speculative ideas may begin to look reasonable. After all, if success arrives, gains will be dramatic. But speculation financed with debt can be explosive. When it works, confidence may grow beyond healthy limits. When it fails, recovery may be impossible. Borrowing also affects sleep. Even if markets remain calm, the knowledge of obligation sits in the background. The investor knows that bad luck must be avoided. This awareness can create anxiety, and anxiety often leads to poor timing. Selling early, buying late, reacting emotionally to ordinary fluctuations. The freedom to think long-term disappears. Yet leverage continues to attract intelligent people. They see others succeed. They observe amplified wealth. They believe careful management will prevent disaster. Sometimes it does. But when it does not, consequences can define an entire career. The cruel aspect of borrowing is that it often works until it suddenly does not. Years of success may encourage even greater risk. Experience may appear to confirm safety. Then, one unusual event changes everything. Investors who avoid leverage may grow more slowly. They may watch others celebrate dramatic victories. But they retain something precious: staying power. They can survive mistakes. They can endure volatility. They can wait for opportunities. Time remains their ally. Without debt, patience is possible. With debt, patience can become luxury. This difference explains why many conservative investors remain successful for decades. They prioritize survival over excitement. They understand that missing a spectacular gain is painful, but losing the ability to continue is far worse. As this lesson becomes clear, another realization emerges. Even without borrowing, investors are constantly pushed toward action by voices around them. Headlines demand response. Predictions create urgency. Information becomes overwhelming. In such an environment, resisting impulse becomes harder each day. And this pressure leads us toward the next mistake. Listening to noise. Chapter 7. Listening to noise. Modern investors live in a storm of information. News flows without rest. Opinions compete for attention. Predictions arrive every minute. Each voice claims urgency. Each headline suggests importance. In such an environment, silence can feel irresponsible. The investor begins the day intending to think long-term. But after hours of updates, emotions become restless. Something must be done. Noise has a special talent. It makes the temporary feel permanent. It makes the small feel critical. A minor event becomes a major threat. A routine fluctuation becomes a dramatic signal. Perspective slowly disappears. Morgan Housel explains that investing success is tied more to behavior than intelligence. Noise aims directly at behavior. It pushes, it persuades, it provokes. The investor who building a careful plan may abandon it after repeated exposure to confident forecasts. If many people sound certain, doubt feels uncomfortable. But certainty in markets is often illusion. Experts speak with conviction. Charts appear persuasive. Arguments seem logical. Yet the future remains unpredictable. Noise rarely admits this. Instead, it rewards drama. Calm analysis does not attract attention. Bold statements do. So the loudest voices become the most visible. Investors may start believing that constant awareness is necessary for safety. If something changes, they must know immediately. But reacting quickly is not always wise. Important developments usually unfold over time. True shifts in value are rarely decided in minutes. Patience often provides clarity. Noise, however, does not encourage patience. It encourages movement. Another problem arises. When investors consume too much information, they may find evidence for any opinion. Optimism is supported. Pessimism is supported. Confusion increases. Without a stable framework, decisions become emotional. Peter Lynch once noted that if you spend more than a short time listening to forecasts, you may lose sight of what actually matters. Business performance takes time. Headlines change hourly. The mismatch is dangerous. Noise can also damage confidence. When markets fall and negative commentary dominates, fear intensifies. The investor may feel isolated. Holding steady appears reckless. Selling can feel like relief. Later, when recovery begins, regret may follow. The same process works in reverse during booms. Positive news creates excitement. Caution feels outdated. Buying feels urgent. The investor is carried from one emotional extreme to another, guided not by strategy, but by volume. There is also a subtle addiction involved. New information provides stimulation. Checking updates becomes habit. Habit becomes dependency. The mind begins to crave explanation for every movement. But many movements have no meaningful explanation. Markets are influenced by countless small decisions. Trying to interpret each one can exhaust even disciplined people. Fatigue reduces judgment. In tired moments, simple reactions often replace thoughtful analysis. Investors who wish to protect themselves must learn to filter. Not every opinion deserves attention. Not every event requires response. This skill is difficult. It may even feel unnatural in a connected world. But without boundaries, noise will dominate thinking. Some successful investors deliberately limit exposure. They read less. They focus on fundamentals. They create distance from emotional waves. This approach may appear slow. It may seem detached. Yet it preserves clarity. Clarity allows conviction. Conviction allows patience. And patience is essential for long-term results. Noise, by contrast, lives in the present moment. It rarely considers decades. It asks what will happen today. What will happen tomorrow? Serious wealth, however, often depends on what happens over many years. When investors shorten their horizon, they may abandon powerful opportunities too early. They may trade frequently. They may chase trends. They may never give compounding the time it requires. Eventually, some realize that constant listening has not improved outcomes. It has only increased anxiety. This realization can be liberating. Silence begins to feel valuable. Independent thought becomes possible again. Yet after escaping the pressure of noise, another challenge appears. Even with a good plan, even with reduced distraction, waiting remains hard. Results may come slowly. Progress may seem invisible. In these quiet stretches, impatience can grow, and impatience leads directly to the next mistake: lack of patience. Chapter 8. Lack of patience. Patience sounds simple. Wait. Allow time to work. Trust the process. In theory, most investors agree. In practice, patience can feel unbearable. We live in a world that celebrates speed. Messages arrive instantly. Results are expected quickly. When progress is slow, frustration grows. Investing often moves at a different rhythm. Value develops gradually. Strategies require endurance. The distance between decision and reward can be long. During this waiting period, doubt begins to whisper. Maybe something better exists. Maybe others are moving ahead. Maybe staying still is a mistake. These thoughts can become powerful. Warren Buffett has said that the stock market is a device for transferring money from the impatient to the patient. This transfer happens quietly, year after year. Impatient investors rarely intend to sabotage themselves. They simply grow tired of waiting. They want confirmation. They want visible progress. When excitement appears elsewhere, discipline weakens. A new trend promises faster reward. A new story offers immediate action. The old plan suddenly feels dull. But dullness is often the environment where compounding does its best work. Great outcomes frequently look boring while they are developing. Because nothing dramatic happens, investors may assume nothing important is happening. They underestimate invisible growth. Compounding is powerful precisely because it is gradual. Small improvements accumulate. Reinvestment multiplies effect. But this requires continuity. Each time an investor abandons a strategy too early, the clock resets. Progress that was building disappears. Impatience is especially dangerous after temporary disappointment. Every investment experiences periods of difficulty. Prices may stagnate. News may be discouraging. If expectations were unrealistic, frustration becomes intense. The investor begins searching for relief. Selling provides emotional release. It ends uncertainty. But it may also end future reward. Morgan Housel writes that the highest returns tend to belong to those who can stay calm while others demand action. Calm is rare during slow progress. Another challenge with patience is comparison. When friends appear successful, waiting feels like falling behind. When media highlights dramatic winners, ordinary growth seems inadequate. The investor may forget personal goals. He begins competing with strangers. This competition is endless. There will always be someone moving faster. Trying to match every opportunity can lead to constant change. Constant change disrupts compounding. Patience also requires faith in preparation. If research was shallow, waiting becomes terrifying. Doubt remains strong. But if decisions were made carefully, patience becomes more comfortable. Confidence in process supports endurance. Still, even with preparation, emotions can challenge resolve. Humans naturally prefer immediate reward. Future benefit feels abstract. To wait for something unseen demands imagination and trust. Many abandon this effort. They prefer visible activity. It creates the feeling of participation. Yet participation without progress is empty. The market does not pay for movement. It pays for correct decisions held long enough to mature. Impatience often disguises itself as prudence. The investor tells himself he is being responsive. He believes he is adapting to new information. Sometimes adaptation is wise. Often, it is escape from discomfort. Distinguishing between the two is difficult. Time can clarify, but impatience resists time. Investors who master waiting develop a quiet advantage. They do not feel forced to chase every trend. They can observe without reacting. This ability reduces mistakes. It also improves emotional health. When the need for immediate reward disappears, pressure declines. Investing becomes more sustainable. Yet patience should not be confused with stubbornness. Evidence may change. Mistakes may appear. Flexibility remains important. The challenge is to respond thoughtfully rather than impulsively. This balance is delicate. Many people lean toward action because waiting feels weak. But history often celebrates those who endured long periods of uncertainty. Their success appears obvious later. During the journey, it rarely did. Understanding this can provide strength. The investor learns that discomfort is normal. Slow progress is normal. Nothing is broken simply because excitement is absent. With this mindset, compounding can continue undisturbed. However, patience can create another subtle danger. If waiting produces success, confidence may increase. After repeated wins, the investor may begin to believe skill is superior. Caution may fade. This shift leads toward a familiar enemy: overconfidence. Chapter 9. Overconfidence. Success feels wonderful. It brings satisfaction. It brings relief. It can also bring danger. After a series of good outcomes, investors may begin to trust their judgment more than the evidence. They may believe they understand the market deeply. They may feel prepared for any situation. Confidence is necessary in investing. Without it, decisions become impossible. But when confidence grows beyond reality, vulnerability increases. Daniel Kahneman spent a lifetime studying how human beings misjudge uncertainty. One of the most powerful tendencies he described is the illusion of knowledge. We often believe we understand more than we truly do. In markets, this illusion can be costly. A few successful investments may convince someone they possess special insight. They may attribute results entirely to skill. They may ignore the role of favorable conditions or simple luck. This interpretation changes behavior. Risk that once seemed frightening now feels manageable. Concentration increases. Caution decreases. The investor begins to move faster and with greater size. Because previous decisions worked, future ones are expected to work as well. Yet markets are not obligated to repeat history. Conditions evolve. Competitors adapt. Economic environments shift. A strategy that succeeded before may struggle tomorrow. Overconfidence resists this possibility. It prefers certainty. Warren Buffett has often emphasized the importance of staying within a circle of competence. Knowing what you do not know can be more valuable than bold prediction. But when confidence expands, circles expand too. Investors may begin exploring areas they do not fully understand. They rely on intuition instead of analysis. At first, results might still be favorable. This reinforces belief. The cycle becomes self-strengthening. Soon, humility fades. Warning signs may appear, but they are dismissed. Dissenting opinions seem uninformed. The investor trusts personal judgment above all else. This is a fragile position, because when mistakes finally occur, they may be large. Another effect of overconfidence is impatience with limits. Diversification can start to feel unnecessary. Why spread capital if conviction is strong? Concentration promises greater reward, but it also magnifies error. Overconfidence narrows attention. It encourages focus on supporting evidence while ignoring contradiction. This is comfortable. It protects ego, but it reduces accuracy. Markets frequently punish those who feel most certain, not because confidence is wrong, but because excessive confidence reduces preparation for surprise. Surprises are constant companions in investing. Even brilliant analysis cannot remove them. Investors who remain humble leave room for unexpected outcomes. They build cushions. They diversify. They admit that they might be wrong. Those who feel invincible often see such precautions as weakness, until reality proves otherwise. There is also social reinforcement. Success attracts admiration. Others may seek advice. Media may offer attention. Praise can deepen belief in personal superiority. It becomes harder to step back and question assumptions. No one enjoys doubting themselves while others are celebrating. Yet history is filled with examples of highly respected investors who suffered greatly after periods of triumph. The pattern repeats because psychology repeats. Confidence slowly transforms into certainty. Certainty transforms into risk. Risk eventually meets reality. Overconfidence can also distort memory. Wins are remembered vividly. Losses are minimized or blamed on unusual events. This selective recall strengthens belief in skill. Learning becomes difficult. Without honest evaluation, improvement stops. The investor may continue using outdated methods long after conditions have changed. Meanwhile, markets continue evolving. Humility keeps curiosity alive. Overconfidence ends it. And when curiosity ends, vulnerability begins. Managing this tendency requires deliberate effort. Some investors create checklists. Some seek opposing opinions. Some regularly review mistakes. These habits can feel uncomfortable. They challenge pride, but they provide protection. Admitting uncertainty does not weaken decisions. It strengthens preparation. It allows room for error without disaster. Perhaps most importantly, humility preserves emotional balance. If expectations are realistic, disappointment is manageable. If expectations are extreme, disappointment can be devastating. Overconfident investors often swing between euphoria and despair. Humble investors experience steadier progress. They understand that success is never permanent. They understand that failure is always possible. This awareness may reduce excitement, but it increases survival. And in long journeys, survival is everything. Eventually, many investors recognize that intelligence alone is not enough. Experience alone is not enough. Without discipline, confidence can betray them. They return, sometimes painfully, to fundamental principles. Save regularly. Diversify. Respect uncertainty. These ideas may appear ordinary, yet ignoring them has destroyed countless fortunes, which brings us naturally to the next mistake: forgetting the simple rules. Chapter 10. Forgetting the simple rules. In every field, basics create stability. In investing, they create survival. The principles are familiar. Live below your means. Save consistently. Diversify. Think long-term. Control emotion. Nothing here sounds revolutionary. Because they are ordinary, many investors underestimate them. They search for advanced strategies. They seek complex models. They assume brilliance must be complicated. Yet history shows that ignoring fundamentals has cost people enormous sums. John Bogle spent decades repeating that simple, disciplined investing often outperforms energetic speculation. His message was clear. Costs matter. Time matters. Behavior matters. But simple ideas are easy to abandon. When markets are exciting, basic rules may feel restrictive. They can appear slow. They may limit dramatic gains. The investor begins to wonder if caution is outdated. Perhaps new methods have replaced old wisdom. Perhaps innovation has made risk smaller. These thoughts are seductive. They invite experimentation without preparation. Soon the portfolio becomes complicated. Positions multiply. Strategies overlap. Clarity disappears. When outcomes are good, confusion hides behind profit. When outcomes are poor, understanding is difficult. The investor may not even know what went wrong. Simple rules exist to prevent such chaos. They create structure. They reduce unnecessary exposure. They also conserve mental energy. Instead of constantly inventing, the investor can focus on consistency. Consistency is not glamorous, but it is powerful. Charlie Munger often praised the ability to avoid stupidity rather than seek brilliance. Many disasters begin with unnecessary complexity. Simple approaches may not promise extraordinary excitement, but they frequently produce reliable progress. Forgetting basics also weakens discipline. If saving regularly stops, capital cannot grow. If diversification is ignored, volatility increases. If long-term thinking disappears, emotional reactions dominate. Each small abandonment may seem harmless. Together, they can become destructive. Another problem with neglecting fundamentals is that recovery becomes harder. When a complicated strategy fails, repairing it may require more complexity. New layers are added. Confusion deepens. Instead of returning to simplicity, the investor moves further away. This path can be exhausting. Many people eventually realize they have built systems they no longer understand. They may depend on experts. They may depend on constant monitoring. Peace of mind vanishes. Yet the original goal of investing was not constant stress. It was security and growth. Simple rules are often aligned with this goal. They allow investors to sleep. They allow attention to shift toward family, work, and life. Complicated methods often demand continuous involvement. Ironically, the pursuit of superior results may damage overall happiness. Why do people forget basics so easily? Because success can create restlessness. After steady gains, ordinary progress may feel insufficient. The investor wants acceleration. He believes he has earned the right to be bold. This belief can lead away from discipline. Sooner or later, markets usually remind participants why rules exist. Volatility increases. Unexpected events arrive. Those who respected fundamentals experience discomfort, but they remain stable. Those who abandon them may face crisis. The difference often lies not in intelligence, but in preparation. Returning to basics after loss can be painful. Regret may appear. Confidence may weaken. Yet many successful investors describe this return as necessary. They rediscover the value of patience. They rebuild structure. They learn that mastery is often repetition of simple actions done well. The beauty of fundamentals is that they are accessible. They do not require genius. They require commitment. Commitment over years can achieve what brilliance over days cannot. Investors sometimes search for secret knowledge. They imagine professionals possess hidden formulas. In reality, many professionals rely on the same principles available to everyone. The difference is adherence. Rules only protect those who follow them. Reading them is not enough. Forgetting them may happen gradually. One exception here. One adjustment there. Eventually, the foundation weakens. Storms reveal the damage. Remembering basics can feel humbling. It means admitting that complexity did not provide safety. But humility opens the door to resilience. With fundamentals restored, the investor can continue the journey with greater awareness. Yet even with rules in place, another challenge remains. Human emotion does not disappear simply because guidelines exist. Fear and greed continue to visit. They can still influence decisions. Understanding how to manage them becomes essential. And so we arrive at the next mistake: the emotional trap. Chapter 11. The emotional trap. Every investor carries emotions into the market. Hope arrives, fear arrives, excitement and regret take turns. These feelings are natural. They are part of being human. The challenge is not to eliminate emotion. The challenge is to prevent emotion from taking control. During calm periods, this seems easy. Plans look solid. Commitments feel strong. But markets rarely remain calm. Prices rise rapidly, and confidence expands. Prices fall sharply, and anxiety spreads. In those moments, logic can disappear. Benjamin Graham described the market as a partner who shows up every day offering different prices. Sometimes the offers are attractive. Sometimes they are ridiculous. Emotional investors treat every offer as instruction. If prices jump, they feel compelled to buy. If prices drop, they feel compelled to sell. The market becomes leader. The investor becomes follower. This reversal can be very expensive. Emotions are powerful because they promise protection. Fear says, act now before things get worse. Greed says, act now before opportunity disappears. Both demand urgency. Urgency reduces thinking time. When thinking time shrinks, mistakes grow. Another difficulty is that emotions feel like truth. They arrive with intensity. They create physical reactions. Ignoring them can seem irresponsible. Yet history shows that strong feelings often appear at the wrong moments. Maximum fear tends to occur near bottoms. Maximum excitement tends to appear near tops. By reacting emotionally, investors may repeatedly buy high and sell low. The pattern can continue for years. Howard Marks has written that successful investing requires second-level thinking. It asks not only what is happening, but how others are likely to react. Emotions make second-level thinking difficult. They focus attention on immediate relief. Selling during panic can reduce stress instantly. Buying during euphoria can create a sense of participation. Both provide comfort in the present. Neither guarantees wisdom for the future. Emotional control is especially hard when money represents security. Loss can feel personal. It can threaten identity. Under such pressure, rational behavior demands training. Investors who prepare in advance often handle volatility better. They expect discomfort. They understand that declines are normal. Because events are familiar, reaction becomes calmer. Those who never imagined difficulty may feel shocked. Shock leads to rapid decisions. Rapid decisions often ignore long-term plans. Another emotional challenge is regret. After missing an opportunity, investors may rush into the next one. They want to repair disappointment. This urgency can lead to poor choices. Regret is backward-looking, but it influences future behavior. Without awareness, cycles repeat. Building defenses against emotion requires structure. Some investors write investment theses. Some create rules for rebalancing. Some limit how often they check prices. These habits may seem restrictive, but they create stability when feelings intensify. There is also value in perspective. Markets have survived wars, recessions, political conflict, and innovation. They have declined many times. They have recovered many times. Remembering this history can soften panic. Emotions try to convince us that the present moment is unique. Often, it is simply another chapter in a long story. Experience gradually teaches investors that feelings change. Fear eventually fades. Excitement eventually cools. Acting permanently on temporary emotion can therefore be dangerous. Patience allows intensity to pass. When clarity returns, decisions improve. This does not mean ignoring all signals. Real risks exist. Real opportunities exist. The task is to evaluate them with balance. Balance becomes possible when emotion is acknowledged but not obeyed. Mastering this skill may be one of the greatest advantages an investor can develop. Because while knowledge is widespread, emotional discipline is rare. Those who maintain it often avoid catastrophic errors. They may not always achieve spectacular victories, but they remain in the game. And remaining in the game allows compounding to continue. After years of experience, many investors reach a quiet conclusion. The enemy was never the market alone. It was their own reactions. Understanding this truth can be transformative. It shifts attention from prediction towards behavior, from excitement toward preparation. With this awareness, mistakes become teachers rather than disasters. And so we arrive at the final step of our journey. What does wisdom look like after recognizing all these traps? How should an investor move forward? Let us close with the price and the power of understanding. Final thoughts. The price of wisdom. Chapter 12. Final thoughts. The price of wisdom. Wisdom in investing rarely arrives as a gift. It is usually purchased through experience. Sometimes the price is small, sometimes it is unforgettable. Most people begin the journey believing success depends on finding the perfect opportunity. They search for the next great company, the next big trend, the next rapid rise. Over time, many discover a different truth. Avoiding large mistakes may matter more than finding extraordinary winners. This idea can feel disappointing at first. It sounds less heroic. It does not promise dramatic stories. Yet it has protected countless fortunes. Charlie Munger liked to say that a great deal of success comes from consistently not being stupid. The statement is simple. Its application is demanding because temptation is constant. The desire for speed returns. The crowd becomes persuasive again. Noise becomes loud. Confidence rises and falls. Even experienced investors are not immune. Wisdom, therefore, is not a permanent condition. It is a practice. It must be renewed regularly. Each generation believes it is seeing something new. Each cycle feels unique. Technology changes. Communication accelerates. But human nature remains remarkably similar. Greed and fear continue their dance. Optimism expands during prosperity. Caution returns during decline. Those who remember this rhythm may navigate more safely. They recognize excitement without surrendering to it. They respect fear without being ruled by it. Wisdom often appears quiet from the outside. It may look like inaction. It may look conservative. But inside that calm lies preparation. Portfolios are built with care. Expectations remain realistic. Liquidity is respected. Because the wise investor understands that uncertainty never disappears. Warren Buffett has said that the most important quality for an investor is temperament, not intellect. Temperament determines reaction. Reaction determines outcome. Learning to manage temperament can take years. There will be moments of doubt, moments of envy, moments of regret. Wisdom does not eliminate them. It helps place them in context. Instead of commanding action, emotions become information. They are noticed. They are evaluated. But they are not automatically obeyed. Another aspect of wisdom is acceptance. No strategy wins all the time. No investor avoids every error. Expecting perfection creates frustration. Accepting imperfection encourages resilience. Resilient investors recover. They adapt. They continue. This continuity is where compounding works its magic. Years of steady behavior can achieve extraordinary outcomes. Not because each decision was brilliant, but because disasters were avoided, small advantages accumulated. The patient gained ground quietly, while others searched for miracles. Eventually, perspective shifts. Investing becomes less about excitement and more about stewardship. Capital is treated with respect. Opportunities are evaluated carefully. The goal changes from winning quickly to lasting. This change may not attract headlines, but it often creates peace. And peace has value beyond numbers. When investors sleep well, think clearly, and act deliberately, life improves. Wealth then becomes a byproduct of discipline rather than obsession. The price of wisdom may have been paid through earlier mistakes. Memories of loss remain, but those memories serve a purpose. They remind the investor to stay humble. They reinforce caution when confidence grows too strong. They encourage gratitude during success. In this way, past pain becomes future protection. Every market cycle will present new temptations, new narratives, new reasons why rules no longer apply. Wise investors listen politely. Then they return to principles. They save. They diversify. They think long-term. They manage emotion. These actions may never become fashionable, but they remain effective. In the end, investing is not a battle against others. It is a partnership with time. Time rewards discipline. It punishes recklessness. Those who understand this relationship can approach the future with quiet confidence. Not certainty, but readiness. And readiness, sustained over many years, is often enough. Fortunes are not only built by brilliance, they are preserved by wisdom. That is the lesson repeated across generations. That is the lesson available to anyone willing to learn. And for those who do, the journey becomes less frightening and far more meaningful.